with me today is John Knotts, who's the CIO at Expressive Wealth with 135 million in AUM or assets under management. How do you handle risk management? What are some mistakes you see people make with respect to risk management?
You have to assess your risk tolerance. What can you afford to lose? What type of risk can you take?
How about the timeless mistakes?
The biggest mistake I see all the time is following the herd.
Let's talk about the best piece of advice you'd like to give the audience or your 30-year-old self.
I think
And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is John Knotts, who's the CIO at Expressive Wealth with 135 million in AUM or assets under management. John, thank you so much for taking the time and welcome to the Smart Money Circle.
thank you. It's a pleasure to be here.
So John, I always like to begin. Can you please tell us your story and how you got to where you are today?
Sure. I am thrilled to be the Chief Executive Officer, Chief Investment Officer at Expressive Wealth. My journey started in finance on a farm. I grew up working on a farm, and from there, I learned the value of commodities, supply and demand. This was during the Great Inflation. So, inflation, unemployment was rampant, but I learned very quickly that farmers depended on the price of soybeans and corn in Chicago, and they always complained about the traders. I learned very quickly that finance and stocks played a big role in investments and in people's lives. So I made it a passion of mine to get into finance. At an early age of 14, I started investing in the market. From there, I
Wow.
skipped school at 17 to be part of the 1987 stock market crash. So
Wow.
that was fun. And, I was also a competitive swimmer. So being a swimmer, you learn a lot about investing or swimming. There's a lot that relates to investing. You have to be disciplined, patient, and you have to keep putting effort in for the long term. So I loved the swimming aspect and how it came. But, I had for 30 years, I worked in the financial sector over 30 years, where I created products for Zacks Investment Research, Profit.net, which was a technical charting firm, and then Benzinga recently has had a product. So I created a lot of research tools, always been in the investment market. It's all about finding independent research for the bigger firms or even individuals. I also teach personal finance at a local college here, North Central College. My enthusiasm, I love to share that with the students about finance and personal finance.
Love it.
Fortunately, I met Vanessa Martinez here, and she was the founder of Expressive Wealth. And, she had this vision of building long-term financial security with a unique twist, psychology, and making sure that, we integrate financial planning with the aspect of psychology.
I love that. So we've got a lot of overlap here and a lot of different ways to go, but let's just stay focused on your business and your investment strategy. So please let us know a little about Expressive Wealth and your investment strategy.
Well, investment wealth is very unique because we have Dr. Patricia Villarreal that is our clinical psychologist here, and she can help integrate finance with psychology because finance is very emotional. Individuals have to learn to cope with a lot of different stresses in finance and investing in the markets and how to handle economic trends, things like that. So having a clinical psychology in finance is great, especially when it comes to the complexities of building finance. Our models are, we base them around a couple key principles. Those include discipline. We have to be disciplined, stay the course. We have a multi-model approach, which is extremely important to stay diversified. Risk management. We have to practice risk management. It's pretty straightforward. A 100% loss or 50% loss, you need 100% gain. Those,
Yes,
we don't want to run into a situation where we can't make a return back that seems improbable. And then we got to be transparent and adapt. The market is ever changing. But the core in all this is research. I was fortunate enough to have a lot of experience in quantitative and fundamental analysis at Zacks, built a lot of different tools, screeners, and independent research for some of the bigger banks out there that needed to buy independent research. But I was fortunate enough to also work at Profit.net, which at the time was the leading technical analysis firm back, many years ago. So I have a little bit of quantitative, technical, fundamental, a little bit of everything. So we are always looking for consistent revenue growth, earnings, robust balance sheets, and companies with strong profits, products. We want companies that have strong products that have an economic moat, preferably that can withstand any market environment that we have out there.
No, it makes perfect sense. So you're more of a quantitative, meaning you have models and then you follow the models and then you use psychology to stay away from making emotional decisions, which is extremely powerful in a good way or a bad way,
Yeah.
depending on which way the wind blows from the investing standpoint. Is that correct? A
That
good
is
summary?
correct. We use quantitative and fundamental quite a bit. And the psychology, it's really important because, so many individuals want to follow the herd. And we know where that can lead you if you're not careful and cautious. So risk management plays a huge role in it. However, we have to follow the numbers, follow the data, and follow the economic trends that are out there. But psychology is a big, big part of it. Investing is a science, but it's an art too. That it is important to understand all the trends itself and how that affects you.
Yeah, you're preaching to the choir. So I wrote a book. It's called Psychological Analysis. We just
Oh
met. This
yeah.
is our first time. But yeah, the whole idea there is to literally do what you're saying. Is take the emotion out of the decision-making process and teach people how to make rational decisions, not emotional ones. So I mean, I'd love to talk to you offline about that in more detail. But that's really fantastic. So okay, let's talk about the next thing. Let's talk about risk management. You mentioned risk. I've got a chapter in the book dedicated to risk. So, how do you handle risk management? What are some mistakes you see people make with respect to risk management?
Well, risk management, this is probably the most important part of investing. You have to assess your risk tolerance. What can you afford to lose? What type of risk can you take? If you're 5 years from retirement or you're getting ready to buy a house, that's a lot different than somebody that has a lot of free extra money. And then diversification. This doesn't get enough credit out there, but you got to be diversified. And diversified doesn't mean buying all different tech stocks. It means diversified through a variety of different portfolios, be it maybe some fixed income, maybe different sectors in the market. You have to be diversified. And that will help with significant downturns in the market, which do happen. And then the most important thing is this disciplined decision making. You have to be disciplined. Prioritize financial stability. Having strategies, clear exit strategies, continuous monitoring your portfolio, looking for changes. Keep a long-term focus. People are so short-term guided. They are looking to double their money tomorrow. It typically doesn't work that way. We all see occasions where it does, but for the most part, a long-term focus. And I love to say compound interest is the greatest, as Einstein said, it's the sixth wonder of the world, because it does so much for individuals. Compound interest is key. And then the most important thing, um, resist chasing trends. We all see what is going on. And I always like to refer back to the tulip mania back in the 1600s, where people lost their houses because they were investing in tulip bulbs. They mortgaged their house for it. We don't want to be in that situation. There's been tons of bubbles in our, over the last 50 years. We can think of the dot-com bubble, but real estate bubble, there's been a lot of it. Quit, resist the trend,
Love it. So
the hype. That's what
the
I would
hype,
say.
yeah, you're saying not the trend so much, but more like the hype
The
when
hype,
people
yeah.
get too crazy, the madness of crowds, if you will,
Yeah.
that kind of thing. It makes sense.
When everybody on your street wants to buy it, that's probably a sign that it's probably over the top. But
Understood.
we keep looking at it. And we look at the fundamentals.
Makes sense. Okay, next question for you, Paul. Let's talk about timeless lessons that you've learned along the way that you'd like to share with the audience in the market, out of the market, life, business, anywhere you want to go.
Yeah, the most, the key principles that you should look at, lifetime lessons are, you know, think long term. You got to look at the long term strategy of what you want to achieve. Diversification works. Stay diversified because you never know when one sector might be down and the other one's up. For example, this last month, technology was one of the worst sectors in the market. Last year was the best. So being diversified can help insulate some of that. Understand risk. You got to understand the risk. Yeah, the talk of the town right now is crypto. It has came up quite a bit. We have to be cautious. It doesn't make it a bad investment. It doesn't make it a great investment. Just understand the risk that's out there. Manage emotions. Just because your brother-in-law is buying it and your neighbor's buying it doesn't mean that it's the right investment for you. So understanding emotion. And then, compounding is powerful. Stick with that. And then stay adaptable. You have to understand, stay educated, learn. I think though, always be learning. There's always evolution in the market, and you should be learning what's out there, what's new, and is it a fad, is it a hype, or is it something that's worthwhile? Learn more about it.
Love it. And how about the other side of that? Timeless mistakes.
The biggest mistake I see all the time is following the herd. Everybody chasing the hype. I have to be in this today. We can look back just a number of years ago. GameStop and the meme stocks were running out of control. And where are they now? So be careful to kind of in jumping on and following the herd. The other mistake is ignoring risk management. I mentioned that, and then lack of diversification, overconfidence. That's a big one. I made it last month. I doubled my money. I'm going to double again. Maybe you did. Now you're getting overconfident. You can do nothing wrong. The market doesn't usually work that way. You need to stay diversified. Don't get overconfident. Um, I see that happen all the time. And then, as I mentioned earlier, individuals not thinking long term. There's too short term. Again, maybe overconfidence. They're looking I'll be able to retire next week if I double my money again.
Got it. No, makes perfect sense. And let's talk about the best piece of advice you'd like to give the audience or your 30-year-old self.
Well, I think the 30-year-old self, what I would say, start early. Start earlier. I did start when I was 14, but there's a lot of things that I could have done quicker, faster. We all could have. You know, keep learning, always be learning. I can't learn enough about the markets right now, but there's a lot of things that we could be learning about. Psychology or the micro trends or macro trends in the world. Diversify wisely. There's many times I put way too much money in a stock and it hurt. Other times I put it in and it did very well. So, but diversify wisely. Let compounding work for you. Focus on time in the market, not timing the market. Again, it goes back to, diversify wisely, but don't get overconfident. The focus of time in the market, and then practice patience and discipline. These are the key. Be patient. You don't build a house in one day, you build it over time. This is a journey, it's a marathon. So, my timeless piece of advice would be, strategic vision, have a vision, that long-term plan, be adaptable, learn, collaboration, ask people, in the industry or the people you trust, get information, always be learning, collaboration. There's other people that are wiser than you are, always learning. And then, be risk aware. That is so important. So, it all comes down to being disciplined, patient, and diversified and adaptable.
Love it. Well, John, thank you so much for taking the time and best of success. And hopefully we'll have you on again soon.
Thank you. I look forward to it. Thank you for having me.